The word margin scares more new traders away from futures than anything else. They hear it and think, that's how people blow up their accounts. But here's the truth. Margin isn't the danger. Not understanding it is. So let's fix that in the next 6 minutes. Let's start simple. In futures trading, margin is not a loan like it is with stocks. With stocks, margin means borrowing money from your broker and paying interest. With futures, margin is completely different. Futures margin is a good faith deposit. It's the amount you put up to control a contract. Unlike a stock trade where you own the share, in futures you are entering into a binding agreement to buy or sell an asset at a later date. This is why the deposit is called good faith. You aren't paying for the asset yet. You are just providing a financial guarantee that you will fulfill your end of the contract. It ensures you have skin in the game. Think of it like a security deposit on an apartment. Not the full value of the property, it's just what you put down to hold it and show you're a serious tenant. Here's a real example with ES, the emini S and P500. One ES contract controls about $250,000 of the S&P 500, but you don't need $250,000. The margin to hold it overnight is roughly $13,000. To put that in perspective, that's roughly 20-to-1 leverage for positions held past the daily close. Now, if you're day trading, opening and closing within the same session, many brokers only require around $500 per contract. At that level, you are looking at a staggering 500-to-1 leverage. That is immense power. A small deposit controls a massive position. It's powerful, it's efficient, and it's exactly why understanding how margin works is your most important job as a trader. Now, there are 2 types of margin to know. Initial margin is what you need to open a position, your entry ticket. For ES overnight, that's around the $13,000 figure we mentioned. Maintenance margin is the minimum your account must stay above to keep that position open. It's always a bit lower than initial margin. If your account drops below the maintenance level because the trade is going against you, that's when you get a margin call. A margin call sounds terrifying. It's really just a notification. It means your account dropped below maintenance margin, and you have 2 choices. Add funds to bring your account back up to the initial level, or the position gets closed automatically to protect you and the broker. Here's the key insight. A margin call isn't the broker punishing you, it's a safety mechanism. Why does the broker close you out? Because the market moves fast. If the broker didn't close losing positions, a trader could end up losing more money than they even have in their account, resulting in a negative balance. The safety net protects you from infinite loss and protects the integrity of the entire exchange. If you're managing risk properly, using stop losses and not over-leveraging, you should almost never see one. This trips up a lot of beginners. There are 2 margin levels depending on when you trade. Day trading margin applies when you open and close within the same session. It's much lower, sometimes a few $100s per ES contract. Overnight margin, also called initial margin, applies if you hold past the session close. It's much higher because holding overnight carries more risk. Gaps can happen while the market is closed. Overnight risk is one thing, but weekend risk is where the real danger lies. Markets close on Friday afternoon and don't reopen until Sunday night. Major global events can happen while you're unable to exit your trade. This is why overnight margins are significantly higher. The broker is hedging against the unknown. So day traders get access to far more leverage. But that leverage cuts both ways. Which brings us to the most important part. Here's how margin becomes a tool instead of a danger. 1. Never use your full available margin. Just because you can open 10 contracts doesn't mean you should. Trade smaller than your maximum. 2. Always use a stop loss. This caps your downside before a margin call is ever possible. Let's look at the math of a single tick. In the ES, every point is $50. That means every quarter point tick is $12.50. With a $500 margin, a move of just 10 points, which can happen in seconds, represents a 100% gain or loss on your margin. This is why position sizing is non-negotiable. 3. Keep a buffer in your account. Don't trade right at the maintenance line. Give yourself room so normal price movement doesn't force you out. Think of your account balance like a boat. Margin is the anchor, but the buffer is the distance between you and the rocks. If you sail too close to the edge, one unexpected wave can sink the ship. Respecting that distance is the hallmark of a professional trader. 4. Remember, leverage amplifies both gains and losses. The same margin that lets you make $500 on a 10-point ES move loses you $500 on a 10-point move against you. So remember, trade smaller, use stop losses, keep a buffer, and respect the power of leverage. Margin isn't scary when you respect it. It's just a tool. It works beautifully when used correctly and causes damage when used carelessly. So that's margin. A good faith deposit, not a loan. Initial to open, maintenance to keep open, and a margin call as your safety net. If this made margin click for you, subscribe. Every week we break down futures concepts in plain English, no jargon, no hype. And if you want the free weekly market recap delivered every Friday, the newsletter link is in the description. Next video, we're covering prop firms and how regular people trade futures with company money instead of their own. Points and ticks. See you in the next one.